Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. You guys all know we work at Sound Financial Group. This is Corey. Corey is my friend, my fellow content creator, my president of the firm, the compliance director, and probably that last one will be the most important role today because I cannot wait to share with you guys what we pulled together. This is something that is meant for an actual client and for said actual client who will remain unnamed, but we know you're going to see this. This really is all for you, only to do our best to put you in the best possible position in the decades to come with your money, not to make you wrong or to make your spouse wrong, just to let you see things side by side so that you can digest and interpret and then be able to modify action. So,
Paul, I just want to remind you that, most responsible and serious adult in the room is not like my natural, easy to take position. So I will if we have to, but just don't stretch me too much if you
very
can.
well. Very well. So
I don't think it's going to happen. I think we got some really good content today, a really good concept around the volatility buffer that I'm excited to show everyone.
Right on. Well, let me just get everybody prepped for this a little bit. So we talk with folks often about the idea that when you are in retirement and you're taking income, one of the things that's most scary to people is being able to take distributions during a down year. Meaning if you had a year where the market is down, say 30%, and then you take your withdrawal for a couple of years in a row with little to no returns, now suddenly you have compounded that to maybe be closer to a 40% negative return because your negative returns were compounded by your distribution. You accelerated the erosion of your capital. Now, what most times people do then is they try to take their entire portfolio and diminish the volatility on the entire portfolio. Now, here's why that can be a little bit flawed. Now, we're going to look at some actual math here in a few minutes, but I just want you guys to get this in concept, is that while in any given year, we're only going to eat 4% of the pie, okay, that's our 4% distribution. Right. So if we're only going to eat 4% of the pie each year, then why does the entire pie have to be invested conservatively to lower the volatility on the entire pie? Well, it would only be if our asset management advisor isn't creative enough to understand that a dollar can do more than one thing at once. Now, what that requires is that we realize, well, we're only going to spend so much money every year. And then how far out do we need this buffer from the volatility of the marketplace? Hence why we call it a volatility buffer. Now, some of you out there, you already have something like whole life insurance. It's a book value asset. It's guaranteed not to go down in value. It works splendidly as a volatility buffer. And if you have something like that you can use as a volatility buffer, then you implementing this will likely be more effective than the example we're going to give you. So here's the scenario we framed up. The scenario we framed up is a client is being encouraged, and from some reading, et cetera, is being pointed to what I should do is take 100% of my money and put it all in a 50-50 portfolio. Now, in the case of this client, they don't have perfectly invested $3 million rounded, but that's what we're doing here. So what we're doing is we're making a comparison of if you just put all your money in 50-50 and then took a $120,000 withdrawal every year for 21 years, or if you had a portfolio that was 70% stocks, 30% bonds, so clearly more aggressive than this 50-50 portfolio, 70% stocks, 30% bonds, but in addition, we took 2 years of income that we anticipate and we put that into a 20% stock, 80% bond portfolio. That one's acting as our volatility buffer. Again, if you had whole life insurance with a couple $300,000 in it, that would work perfectly fine for this scenario. But for the time being, what we're doing is using a $240,000 volatility buffer, the remaining $2.76 million is in the 70-30 portfolio. We're comparing that to somebody that just went 50% stocks, 50% bonds over the next 21 years, starting at the beginning of the year 2000. That's the example we're about to look at.
So the point being, instead of one warm, like lukewarm portfolio, like one middle of the road mix, having some a lot higher and some a lot lower, and giving those proportionally, it like we're getting a more efficient mix of risk and return.
You got it. And the other thing that we're going to point to when we pull this up here in a moment is that anytime our volatility buffer fell below 240,000, 2 years of volatility buffer, anytime it fell below that, then the following years we topped it back off to get it up to 240,000 or better. Okay, so that's the math we're using, whereas it's very simple for the 50-50 portfolio. It's just a straight $120,000 distribution each year. Okay. So Corey, let me just bring you and I up on the screen here and allow everybody to see this spreadsheet. And what they can see is that right here over the 70-30 portfolio, we have 2,760,000, 240,000 our 2080 volatility buffer. And then we have our $3 million just totally invested in that 50-50 portfolio. The green denotes the years that we took it out of the 70-30 portfolio, and the green denotes in the 2080 the years that we took it out of that portfolio.
And every year it's coming out of the 50-50 on that side, so we don't.
Yeah, so we didn't highlight it exactly. So what you can see is as we get down here to year 3, that's the first year our 70-30 portfolio was not drawn from because the 70-30 portfolio had nearly a 10% downturn that year. You can see over to the left. So that year we drew down our volatility buffer and took withdrawals from it, and we can see what happened. Right there in year 3, 3 years in, it looks like the 50-50 portfolio performed better.
And so just to kind of restate for folks who aren't seeing it, we're looking at the returns, and every year that closes as a negative, we take from the buffer until we see a positive year happens, until it's recovered, right? That's really simple how we're doing it. Okay.
Exactly right. Yep. And so you can see that year 3 in, it looks like the 50-50 portfolio is about $150,000 ahead. We get down to our next downturn, and let's look at the total portfolios on both sides. The one with the volatility buffer has 4.2 million total between the volatility buffer and the 70-30 portfolio, and the 50-50 portfolio is about 4 million. Now that year, because the 70-30 portfolio experienced more downside volatility, we're now behind at 3,090,000. And there again, it looks like the 50-50 portfolio is going to be ahead because it's ahead again now about 130,000.
But I think the point is the 70-30, we didn't lock in the loss from that portfolio. Like, yes, it's fluctuating down, but we're taking it from somewhere else, so we're okay with that.
Exactly right. And as a matter of fact, that 2080 portfolio grew so good beforehand that even after that drawdown, we do not need to replenish it during that window because we still have 2 years worth. So now we get down to the next drawdown in the market that occurred in 2011, where the 70-30 portfolio went down and we drew it from the volatility buffer. And now here we are, dead even with the 50-50 portfolio. But over this 22 years that we're assessing, we have a couple more years. And what we did is we replenished. You can see right here in 2013, we replenished the volatility buffer and brought it back up. That was drawn from the 70-30 portfolio over. And now for the next downturn, we're now at 4.5 million, while the 50-50 portfolio is 4.3.
So what I'm noticing, 2008 was the last time, you can check me if I'm wrong, that the 50-50 was ahead.
Mm-hmm.
And that's because the 70-30 was fluctuating more downward during that really awful downturn. But then money's still coming out of the 50-50. So it's further increasing the pull down, and the 70-30 is able to recover more. And then recovering from that downturn, it's no matter what's happening, it's never our buffer portfolio is never lagging the 50-50 for the rest of the 20-year period.
Exactly right. And by the way, how much better does the person with the volatility buffer feel in the current years? Because in those years, in 2008 as an example, when the 50-50 portfolio was down 17%, you didn't have an option. You could either be in abject poverty that year or take your income. You didn't have a third option or second option or a third or a fourth. You just have to take it from the 50-50 portfolio or go get a job. So the person who's taking it from the volatility buffer is always has a different feeling about taking their withdrawals. Like, think about the quality of life of these two people over 22 years. One person who's always got to take money out even when the market's down versus one person has an extra pool of money that they could pull from. Now, by the way, if you have a lot of whole life cash values, it works even more effectively than a 20/80 portfolio would as your volatility buffer. But not everybody has enough time to build that up. So as we
can qualify from a health standpoint. Like, there's lots of reasons why they might not be able to do that. Yeah.
Exactly right. But now we get out here to the end, and aside from the fact the only difference between these two, these are actually even the exact same portfolios. I want everybody to know the only difference in between them is the mix of equities to fixed income. And we left it pretty conservative even on the portfolio we are drawing from because we did 70-30, whereas somebody having a volatility buffer might feel perfectly fine having an 80-20 portfolio, 80% stocks. Right. But we get down here to the end of the day, and here we are at 7 million versus 5.8 million. The exact same stocks were purchased in the exact same fixed income over this 22 years. The only difference is one had a volatility buffer they could draw from, and the other didn't. Now, we use 22 years here to maybe demonstrate somebody who's 62 years old living to 84. But if, like a lot of married couples, if they're healthy at age 65, they're going to make it well into their 90s. How big does this gap continue to grow over the next 10 years? And the answer is going to be a lot. And that gap continues to grow, giving the person who's using the volatility buffer either the opportunity to take more income than they would have been comfortable with.
That's what I was going to say. There's two ways you can look at this. There's which one ends higher taking the same income, or which one really gives you the freedom to have flexibility and draw more income over time if life requires it. And you find opportunities or
just things you want to enjoy.
You want to do. Yeah.
The world, being an extra $1.2 million ahead could mean that in your 70s, you chose to take a worldwide cruise for 9 months traveling the planet versus worrying about your principal because your principal isn't growing very much. The volatility buffer difference could be the difference between being able to take full inflation increases in your income and having your purchasing power whittled away over time. But one thing's for sure, the 50-50 person definitely couldn't take as much money over this 22-year period as the person who had the volatility buffer, or if the person with the volatility buffer decided to live the same life, they leave a bigger legacy. And so I'm going to kind of go away from the spreadsheet here, Corey, just so we can talk with everybody for a minute.
Sure.
Of what this really boils down to is that there are clubs and then there's swing. There's the tools we can use and then there's strategy. And what you guys are seeing is the use of strategy inside of the same set of tools. And we understand that. Certainly in business, people realize somebody's better at strategy might lead a company better than the person that's very technically oriented. But we sometimes don't make that simple leap to that strategy might make a lot of sense in our personal lives. And people go, well, I just want the quote unquote safer portfolio. And I want that one size cookie cutter option so I don't have to think a lot. Right. And by the way, the many advisors people work with feel the same way. They feel as though it's just easier to implement one strategy for people because certainly this takes more thinking on an advisor's part. This takes more conversations, more coaching, more market discipline than the 50-50 portfolio, because if you have the 50-50 portfolio, 2008 hits and your client just freaks out, well, what do? You say, okay, we'll put you all in cash. And if that happened in 2008, because the portfolio went from 4 million to 3.2 after withdrawals, because the person freaked out that they lost so much, they would have lost a lot more and locked in those losses if the strategy itself of taking out money directly out of the most volatile portfolio you have, in this case 50-50 for this couple, you would have abandoned strategy and locked in those losses for decades to come, maybe never recovering. So the real potential downside of the just taking it out of the volatile portfolio and not having a volatility buffer, the real downside of that story can't be told by a spreadsheet. It's life lived.
And it's not like it's really that much more complicated. I mean, we would probably finesse this. We would finesse this definitely a lot more than just a once a year decision, like we're giving an example. But in this example, it's just 2 buckets versus 1, and once a year you have to make a choice. Like, do you pull out of here or here? Like, it's not that much more complicated.
Nope. But the fact of the matter is, Corey, how many advisors are out there in the world that are willing to take on the extra bit of complication, the extra bit of education of the client on the front end so the client understands why they're doing it so that they can hold the strategy? And that's what I think most happens too often out there. Or like, take any of the no-load companies, not to pick on any of them in particular, but if they rhymed with Vanguard, then try to have this conversation with them about you just have to fully self-implement, because that's not what they're designed to do. They're designed to just do what you tell them to do, not to be able to offer a solution for how you could do what you want to do better.
Right.
And that's what we hope to be able to bring to our clients. And we hope that this video was useful and valuable. And even if it's just, no, we won't be offended at all if this video gets sent to your financial advisor like, we want that thing instead of the 50-50 portfolio. We won't be offended in the least. But if you feel like your advisor doesn't have the ability to have some of these conversations, then feel free to reach out to us. You can throw something in the comments below to get in touch with you, or just email us at info@sfgway, soundfinancialgroupway.com. And, as always, here, Corey and I chatting with you. We do each of these episodes in an attempt, in an effort, and with the intention of helping you be able to design and build a good life. And I hope we've done that for you today. Hope you guys have a great week, and we'll see you next week.